Hi, folks. Dave Berkowitz here. Let me try to unpack what happened over the weekend and towards last week. First thing that everybody needs to know is that we had a run on a bank. And the run on the bank was called Silicon Valley Bank. It's the 16th biggest bank in the country, or was. It was closed on Friday by the federal government. It was the second biggest bank failure in United States history. As recently as November 2021, the bank was worth about $44 billion in the stock market. It's now worthless. The shareholders lost all their money. There's a lot to this story, but it really boils down to an old-fashioned bank run. A flood of withdrawals from depositors destroyed the bank. The classic scene in It's a Wonderful Life depicts an old-fashioned bank run. Bank runs happen when customers panic and everyone simultaneously tries to get their money out. The bank can't pay everyone at once, of course, and the bank fails. That's what happened in It's a Wonderful Life. People learned about a problem at the Bailey Savings and Loan. The crowd mobbed the Savings and Loan. George explains where the money is, that it's in the homes built in Bedford Falls by the Savings and Loans. It was in the mortgages that everybody took out. And those assets can't be sold quickly, and Uncle Billy lost today's deposit. And that's what happened. So let's listen.
We don't need Potter over here.
And I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
Okay, Tom. All right. Here you are. You sign this. You get your money in 60 days.
60 days?
Well, now, that's what you agreed to when you bought your shares.
Tom, did you get your money?
No.
Well, I did. Old man Potter will pay 50 cents on the dollar for every share you got. Yes, cash.
Well, what do you say?
No, Tom, you have to stick to your original agreement. Now, give us 60 days on this
Okay,
thing.
Randall.
Are you going to Potter's?
Better to get half than nothing.
That's what I need.
Tom! Randall, now, Randall, wait a minute. Now, wait. Now, listen to me. I beg of you not to do this thing. If Potter gets a hold of this building and alone, there'll never be another decent house built in this town. He's already got charge of the bank, he's got the bus line, he got the department stores, and now he's after us. Why? Well, it's very simple, because we're cutting in on his business, that's why. And because he wants to keep you living in his slums and paying the kind of rent he decides. Joe, you had one of those Potter houses, didn't you? Well, have you forgotten? Have you forgotten what he charged you for that broken down shack? Here, Ed, you remember last year when things weren't going so well and you couldn't make your payments? Well, you didn't lose your house, did you? You think Potter would have let you keep it? Can't you understand what's happening here? Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not, that's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
I can't keep my kids on faith. I've got to have...
How much do you need?
Hey! I got $2,000. Here's $2,000. This will tide us over to the bank reopens. All right, Tom, how much do you need?
$242.
No, Tom, just enough to tide you over until the bank reopens.
I'll take $242.
There you are.
That'll close my account.
Your account's still here. That's a loan. Okay. All right, Ed.
Well, I got $300 here, George.
All right, now, Ed, what'll it take until the bank opens? What do you need?
Well, I suppose $20?
$20. Now you're talking. Thanks, Ed. That's fine. All right, now, Miss Thompson, how much do you want?
But it's your own money,
Now,
George.
never mind about that. How much do you want now?
I can get along with 20, all right.
$20, fine.
And I'll sign the
There you are.
paper.
You don't have to sign anything. I know you pay when you can. That's okay. All right, Miss Davis.
Could I have $17.50?
Bless your heart. Of course you can have it. You got 50 cents. There we go. 7.
We're gonna make it, George.
6.
They'll never close us up today.
5, 4, 3, 2, 1. Bingo!
Well, that didn't happen at Silicon Valley Bank. And the reason why it didn't happen is because, you know, we just had a touch of a button and everybody was taking their money out of the account. By one account, they lost $45 billion in deposits in 10 hours. Now, how can that be? Well, you know, you don't have to go to the building and loan and actually negotiate with George to get your money out. No, you just go on an app and hit a transfer, and then your money is already in your new account. So you didn't need a line at Silicon Valley Bank because we're living at lightning speed. Money is transferred from one bank to another with an app and an iPhone. Modern bank runs happen very, very quickly, as we saw over the weekend and last Friday. Silicon Valley Bank, like any other bank, puts customer deposits to work, just like the building and loan. In that case, he put money into mortgages that help people build their homes. The issue here is that SIVs, or Silicon Valley Banks, deposited went skyrocketing during the pandemic because they thought it was wise to put a lot of those funds that they got during the pandemic into mortgage-backed securities and treasury notes, believe it or not, yielding on average 1.63%. Well, to some extent, you know, if they were a person, I couldn't blame them because, you know, we've been at 0% interest rates for a number of years, and they thought that was a pretty good deal. You buy mortgages that are backed by Fannie Mae and Freddie Mac, or you buy Treasury securities. That's a quality investment. They're going to get paid back. But the problem is that afterwards, the Fed began increasing rates at a very, very fast rate. It made all those 1.63% fixed income products less and less valuable. So if you needed it to sell them right away, you would have had to take a loss. Remember, bond prices and bond interest rates are inversely related. So yields go up, bond prices go down, and if you have to sell it, you can't hold it till it matures, then you're going to take a loss. And it means that those bonds that Silicon Valley Bank was holding were losing value every day and every minute. That's where it gets even dumber. Not only was it a blunder to put so many assets in such low-yielding investments when all of Chairman of the Fed Powell spoke about was more rate hikes coming for over a year, but the bank also didn't even hedge their exposure. This is the main root of the issue. Most banks understand how important it is to match their assets, which in this case are those treasury bonds and mortgages. In building and loans case, it was mortgages or buildings that they had help people build. It looks like Silicon Valley did not get the memo. The company is known for holding the deposits of very young corporations that don't make any money. So those companies need the amount of money that they raised and that they deposited it at Silicon Valley, and they needed it pretty much all through the last year or so because with a higher inflation environment, they needed to access that money to pay their bigger and bigger bills. So what did Silicon Valley have to do to make sure they were liquid enough? Well, they had to start selling assets. And they sold approximately $21 billion of securities, which resulted in an after-tax loss of approximately $1.8 billion. That happened last week. And then on Wednesday, inexplicably, they told the world that they were basically insolvent. And the panic, Twitter steps in, and the panic ensues. Now, I want everybody here to understand that the stock market went down last week. The stock market in some indices went down today. Small caps really are doing very poorly. Our stocks are doing okay. We had a middling day. We didn't make a lot of money, but we didn't lose a lot of money in the value aligned model portfolio. But I want to argue with you that none of this matters. It doesn't matter to any of us. See, you and I are long-term, goal-focused, plan-driven stock investors. Lifetime investment success comes from acting continuously on a plan. That means that you're saving a certain amount of money while you're saving, and then during retirement, we already know what you're going to require, so you have enough money to do what you need to do and to maintain your lifestyle. So nothing matters. No, it doesn't matter what your friend is doing in the stock market. It doesn't matter what some indice is doing, what some relative is telling you that they did so great and you didn't, and none of it matters. The only thing that matters is your lifetime after-tax return. That's the only thing that matters. And that's the thing we focus on here. We focus on the rate of return that you need, because we believe that substandard returns and even lifetime could lead to lifetime investment failure. And that means reacting to current events. So that's like panicking because a bank failed. Bank failed, and then the Fed stepped in, and at least for the time being, it looks like the crisis was averted. Now, I guarantee you that we're in a world of hurt now, because banks were paying like 0.5% to 1.25% on their deposits. Well, they're not going to get away with that anymore. If they want to keep their deposits, they're going to have to pay a market rate or close to a market rate on those deposits. See, in a money market fund, right now they could get 4%, 4.5% on a money market fund. And yeah, they're not quote unquote insured, but at the same time, that's a big difference. And what this episode showed the world is that the banks are under paying their depositors, and it's gonna mean a lot of earnings declines and a lot of problems for the banks going forward. So the unforeseen and indeed unforeseeable economic, market, political, geopolitical chaos of the 3 years since the onset of the pandemic demonstrates that the economy can never be consistently forecast by anyone, nor the stock market can be consistently forecast by anyone or timed. And thank God, because we don't need it. Therefore, we believe that the most reliable way to capture the full return of shares of our businesses is to ride out the frequent, but historically always temporary market declines. These will continue to be the bedrock convictions that inform our investment policy for now and forever as we pursue your most important financial goals together. Although this may be hard to remember every time the market gyrates and financial journalists shriek about the end of the world, remember, they just need clicks. So it's always going to be an emergency. It's always going to be the end of the world, and you're never going to get the right thing. If you want to understand what's going on, please call me. I'm happy to anytime put everything into perspective, and especially your savings. Your savings are you and I are not investing in the macro economy. You understand that? We're not investing in the economy. We're investing in portfolios that largely consist of the ownership of enduringly successful companies. These are businesses that we're invested in, not shares of stock. We don't care about the temporary fluctuations. We care about how the businesses are doing. And let me tell you, we have a collection portfolio of great businesses that are, even now, right now, you can be reassured that all those businesses are refining their strategies to meet the needs and wants of about 8 billion people in the world. And I like what we own, and you should too. Now, I can't be remiss but leave you with this. This is a chart of the S&P 500, which is widely thought of as the market, and it's from the year I was born. So I was born in 64, so this is at the end of 63, and you can see that the price of the index is up 51 times. And the dividends themselves are up nearly 30 times in that period. Inflation isn't even close. And if you never sold during that period of time, you never paid any taxes, except for on dividends, of course you did. But on the price appreciation, if they're unrealized gains, you didn't pay any taxes. But my point, of course, is take the long look. You should see that every bit of fluctuation, every bit of downdraft was always temporary. And that's historical. I'm not making a prediction. I can't guarantee it, but it's a pretty good bet that you're going to get over time a 10% return or so total return in the stock market or in shares of great businesses, and that's what we own. With that, please, anybody needs anything else, you can email me, you can call me. I'm happy to talk to anybody that has anything of concern. But just remember, you didn't lose anything on Friday. You didn't lose anything today. You didn't lose anything in the great financial crisis unless you got out of the market. Then you had a problem.